Hello, ladies and gentlemen. It's Jesse Colombo. Can you let me know if you can hear me? It's the first day we're doing this Forex and Futures update a little bit differently. We're doing it combined with the closing bell that begins at 4:30 p.m. So it's nice to have everyone in the same room. And in addition, I'm using new charts so I can draw my trend lines that you guys find useful for your trading, and I find it a bit easier too. So as usual, I'm just going to start with the S&P 500. The rally has continued. I've been discussing this rally for the past few weeks and actually wrote a column about it where I was showing a triangle pattern that I was watching. You can see right here, S&P 500. And I showed it before it broke out. It was bouncing around. And then finally, I believe it was early February, it broke out right out of that triangle, which appears to be a continuation pattern. And I was also watching to see if the S&P 500 would break above its late December, early January high, which it did in the last 2-3 days, 2-3 trading sessions. So that's definitely the go-ahead for a real breakout right here. And I'd like to see a true solid follow-through, but so far it's looking good. Of course, if it manages to fall back below this December high, January, December highs, that would definitely negate this breakout. So I'm just going to draw that just so you can visualize it. But it's really just a horizontal line. So we have a breakout, and I was discussing and saying different ways of playing this. If you trade ETFs or you trade stock futures like E-minis or S&P 500 futures, I was discussing using various option strategies for how to play it, such as a straddle. You could buy a put, buy a call if you didn't know which way this was going to break out, and you could have profited as long as there was a breakout, which we did have. And my bias from the beginning was that there was going to be an upside breakout because the prior trend, if you see, for much of October, mid-October up until December, the trend was up. So the breakouts tend to follow through in the same direction as the trend that led into the consolidation pattern. So we're seeing these technical principles at work here right before your eyes. I'm just going to show you really quickly the Dow. It looks very similar to the S&P 500, unsurprisingly. They're both highly correlated with each other, but they do have their own nuances, and I do prefer to do individual analyses as well, just because sometimes it helps for added confirmation. So you can see, just like the S&P 500, it formed some sort of a wedge or triangle. It broke out in early February. Now it just broke above 18,000, a key psychological resistance level, which now should be a support level. And the next hurdle that I'm watching is the late December high, which is just above, actually I think I can tell you right now, it's 18,110 or so. So it's just 18,100 is basically the level I'd like to see it break, just as an added confirmation. Of course, if it breaks back below, then I would consider that to be a failed breakout. So just keep watching. But if you've been following me, you could take advantage of this breakout. Going to show you, I'll show you the NASDAQ 100 because I have been discussing that, and there has been a nice breakout there, even more so than the other stock indices. And I was discussing, I think it was last week, a few times, showing how tech seemed to be leading the market, which is why we saw higher relative strength in the tech-heavy NASDAQ 100 index. So that's why it burst out of the gate a little quicker and a little more aggressively than the more industrial Dow or S&P 500. So it's definitely tech that's leading this rally, unsurprisingly. We've seen that a lot over the last 6 years during this bull market, and this breakout seems to be no exception. Showing you the Japan's Nikkei. Have been discussing this as well. Similar to the U.S. indices, there was a breakout from this consolidation right here. As additional confirmation, I'd like to see it break above the December highs. So figure it's around 18,100. I want to see a clear breakout. Maybe we'll get that in the coming Japanese trading session, which is tonight in the for Americans. So I just want to see if there's a real solid follow through, and it'll continue on from there. I'm also seeing a rising up trend line right here. So it seems to be climbing along there. So we'll see if we get that breakout, another additional breakout tonight where it really follows through. I like to see that. So quickly discuss gold, because this is something I've been discussing as well. Gold continues to break down. I was showing this when it was bumping its head right around 1,300. Show that as a major psychological level. Wasn't able to break above. I wrote a column showing how the smart money was bearish on this gold and silver rebound. They were skeptical. It was mostly led by the dumb money or the large traders, and sure enough, smart money was right again. It sold off from 1305 all the way down to 1208 right now. Pretty significant sell-off. So I'm now watching 1200 as the major psychological support level. I want to see if it maybe tries to hit that level and then possibly bounce from there, or maybe even break below it and then continue to the lows that were reached this past fall, maybe in the low 11s, around 1130, 1140-ish. I'll show you silver briefly. Silver is down significantly today. It was down over 5%. Same thing, smart money was bearish, and it broke the recent low that I was showing right over here. I think it was around 1660. It was consolidating for early February, and it just sliced below that support. So right now the trend is down in the shorter term, so I definitely wouldn't want to be long. And I want to see if it's going to drop back to the low 15s per ounce, which is this cluster support zone for much of the fall, from November to actually late December. All right, let me see if this has the U.S. dollar index. I'm still acquainting myself. I'm using these net Dania charts, which are pretty helpful. Here we go. U.S. dollar index, my favorite. So this is my starting point whenever I'm reviewing Forex. I go right to the U.S. dollar index because the U.S. dollar is the world's reserve currency, and it does tend to be a major driver of global Forex trends. And I've been showing how the U.S. dollar index has been following along an uptrend line for quite a bit of time. This particular trend line goes back at least to October 2014, so I would definitely pay attention to it. And the U.S. dollar index has been consolidating for the past several weeks, maybe even a month. So you can see it's almost a horizontal consolidation. So this is very important. I think we're really at a major pivotal point here with the U.S. dollar and also other currencies, because they trade inversely with the U.S. dollar and U.S. dollar index, as I'm showing here. So the direction that the U.S. dollar index breaks out, I think, is going to really determine the way that the other currencies break out or break down. So if we see a rebound off this rising up trend line, and also rebound off bullish breakout above this consolidation zone, we could see further appreciation in the U.S. dollar and U.S. dollar index, and that would definitely punish non-U.S. currencies as well as commodities, because they trade inversely with the U.S. dollar. On the other hand, if there is a breakdown in the U.S. dollar and it breaks below this rising up trend line as well as this support level over here, that would be a bullish confirmation for non-U.S. currencies and commodities, and certainly be a major technical breakdown in the U.S. dollar, and we could see a longer, maybe an intermediate term and shorter term correction in the U.S. dollar index. So keep your eyes on that. Very important. And there are a lot of important Eurozone financial meetings related to Greece, and it's mostly Greece related in the next few weeks. So I think one of those will end up being the catalyst that causes it to either break out or break down. So just keep your eyes on that if you're trading Forex. The euro versus US dollar currency pair shows a similar pattern, unsurprisingly, because it trades inversely with the dollar index. And it almost looks identical. It almost just looks like a inverted or flipped version of the US dollar index, and that's because the euro has the highest weighting in that US dollar index. So I'm just drawing some lines and I'm seeing, but the big feature of this chart that I'm watching right now is this possible triangle that has been forming. I believe that this is going to lead to some sort of a major breakout or breakdown. I don't know ahead of time precisely which way it's going to break, just like I said about the U.S. stock market. I showed how there was a squeeze or a funneling pattern or triangle. These are all synonyms. They're all really different words for the same concept. But I knew there was going to be a break in either direction. So we're seeing this type of consolidation in the euro versus U.S. dollar. Pardon me. Be mindful of the fact that the prior trend is down for much of December and January, as well as before that. So it does tend to bias this type of consolidation pattern to the downside. So I just want to see if there's going to be a breakdown. At the same time, there has been this euro weakening. This euro bear market has been it's a little bit long in the tooth. So there's a chance at the end of a long move that these types of consolidation patterns, like triangles, end up being reversal patterns rather than continuation patterns. So just keep that in mind after such a long trend, that eventually it becomes a crowded trade and it tends to reverse. So you don't have to predict, or I don't predict in my own trading because I just can't do that, neither can anyone else. I simply react. So I just want to see if there's going to be a breakout, a breakdown, and then we'll take it from there as far as tactical trades. Watching the dollar yen. I've been showing dollar yen for a while as well. Included this in one of my columns. The same column that I was showing those stock market patterns, believe it or not. And I've been showing what looks to have been a triangle, and it did break out. So this means this recent breakout means that the dollar is appreciating relative to the yen, meaning the yen is weakening when you see this dollar yen currency pair break out. So over the last 2 years during the Japan's Abenomics program, the yen has definitely been biased to the downside because Bank of Japan is really trying to print money and stimulate their economy and weaken the yen to help out the country's exporters. So, and the U.S. dollar has been strengthening. So it's really not that surprising to see that the dollar yen experienced a bullish breakout. So I want to see if there's going to be a real follow through. There was a preliminary breakout in early February, and then you can see it retested. And you'll see that. You'll see major consolidation patterns like this triangle right here. Sometimes the market or asset in question will break out and then retest, go back to that level before a final run, and it tends to shake out a lot of traders. So just keep your eyes on this. I want to see if the yen is going to weaken and the dollar is going to strengthen. So watch that pair. Some interesting action right here. Another interesting trade that I have been discussing for quite some time is the New Zealand dollar versus US dollar. And I was showing how there was this consolidation pattern right over here. I showed it before the breakdown in late January. Broke down. I was saying that that could be a good trade if you're interested in shorting the New Zealand dollar. So now, and I was saying for anyone who missed out on this trade, that there could be a second chance to jump in on it if there's a consolidation or a rebound or a retracement. And we've seen that for the last 2 weeks, where the New Zealand dollar, US dollar currency pair strengthened and looks like it's going to be retesting that breakdown point right around 0.76000, another major psychological level. So I want to see if it's going to try to hit that and then continue to sell off from there. If so, and it doesn't manage to break above and close above then there could be a further sell-off. So as far as an actual trigger, I would, for possibly going short, I'd like to see it bump its head at 0.76 and like to see it break below this rising up trend line. So that's really what I'm watching. For me, it's all about confirmation. I want to see confirmation. So this could be an interesting trade. Let's see. Lots of pairs to look at, but let's see if anything's going on with the Australian dollar. Just trying to look through this list. Here we go. It's been Australian dollars continues to be in a confirmed downtrend. Here's this major downtrend line that I'm watching. It's acting as or should be acting as a major overhead resistance level. And I've been discussing this recent consolidation for the past 2 weeks or so. So I want to see what happens if it can either break above or below this. If it breaks to the upside, the next overhead hurdle is that downtrend line, long established downtrend line. And if it could break above there, then it may actually try to launch a bull run. On the other hand, if it breaks below, you can see around 0.77 to the US dollar. That could be a confirmation. That could be definitely a bearish confirmation if it really does manage to break below this support level and continue on in that same direction as the prior trend, which is down. So could be an interesting trade set up there in the next week or so, especially if the US dollar index experiences a bullish breakout. If it experiences a breakdown, like I was discussing earlier, then I wouldn't be surprised to see the Australian dollar, New Zealand dollar, etc., as well as the euro experience bullish breakouts. So I'm always looking to confirm, anytime I want to place a Forex trade, I'm always looking to confirm if the US dollar index is acting in a congruent manner because it trades inversely. So if I see a bullish breakout in non-US currencies, I want to see a bearish breakdown in the US dollar index. Let's look at the Canadian dollar. Here we go. This is the US dollar, Canadian dollar currency pair. So when you see this chart over the longer run, this means that the US dollar is strengthening against the Canadian dollar. Canadian dollar has been selling off significantly due to the oil bust. I'm seeing definitely an interesting pattern here, similar to what I saw in the euro, similar to what I've been watching in the yen. That looks like a clear triangle right there. Definitely worth watching. Definitely, I'm sure that's some sort of a significant pattern. Pardon me, a little bit of a cold. We've been having horrible weather here in New York. So I just want to see how this is going to play out, this consolidation. It's probably going to bounce around for quite a bit more and may take its cue, the final breakout, from the way oil heads. If oil breaks up or breaks down, Canadian dollar is highly correlated, positively correlated with oil. And Canadian dollar is also negatively correlated with the US dollar index. So I think when there's a final breakout from all these consolidation patterns, it's probably going to happen all around the same time. And I'm thinking that there's going to be a single catalyst that causes them to break out. It's probably going to be related to Greece, or either it's going to be a resolution or the Greece talks experience a serious breakdown, and then there's a real fear event in the markets, and the euro continues to fall, and then the US dollar breaks out. I just don't know how this is going to play out, just because no economist does, because it's inherently unknowable, because we don't know what policymakers in Greece and Europe are going to do. And maybe they don't even know what they're going to do 2 weeks from now. So that's all we can do, is just follow the charts, look at these patterns that tend to have predictive value, and then trade the breakouts and breakdowns, and use proper risk control in case those breakouts or breakdowns turn out to be head fakes. Something to be aware of at all times, the potential for a head fake. All right, so I'm going to have to cut this a little bit short today, just because in 10 minutes we're going to be having the closing bell with Tom Busby. We've done many closing bells with him. He's a great partner, and he's going to be giving an interesting webinar called Learn to Trade Earnings. So he's going to discuss all different strategies and tactics for earnings trading. So I'm definitely going to be watching with interest and hope I'll learn something with all of you folks. So, all right, stand by. 10 minutes, he's coming on. Take care. Happy trading.
Ladies and gentlemen, welcome. My name is Fausto Pugliese, President and Founder of Cybertrade University. Thanks, everybody, for being here on Closing Bell. Today I want to introduce a very special friend and one of my best friends, I'll be honest with you. Known him for over 15 years and still counting. Very, very respected in the industry. Very, very well respected as a great educator in today's markets. His name is Tom Busby from DTI, President and Founder of DTI. And for some of you, I've done more events with DTI, with Tom Busby, than any other educator. And I'm not talking about just doing events like today, like webinars. I've been on the road with him. I've been all over Canada, U.S. We're actually planning another big event coming maybe in Texas with TradeStation. We're working on a deal on that. You know, done speakings, and some of you even met me, gone out to dinner with us together. And you know, he's got a great staff, a great product. He's the best educators when it comes to futures, and his reputation speaks for itself. He's been around as long as I have been, in over 20 years, and he just has a passion to teaching people. But we have him come on. You know, it's been a while since he's been here, and we just look forward to having here again. So want to kind of give you guys a little heads up, knowing a little bit more about futures, understanding about what exactly it is. There's no better than to hearing it from Tom Busby and at DTI. So want to pass over the microphone to him and the controls. Tom, the stage is all yours, and thanks for coming.
Well, thanks, Fausto. Wow, I'm really going to have to focus after that introduction. But Fausto's right. We have spent a lot of time together over the years, and I got a call from a trade station. I'm sure he did too. They wanted us to go together and appear out in Texas. They're trying to work out the details on that, and we'll see how that goes. But we had a lot of fun in Canada, working the Canadian markets together, and so I am glad to be here. And I'm a little especially excited about this subject. I don't think I've ever presented this subject before, but one of the things in my long career that's always excited me, and I could never figure it out, was earnings announcements and how to play stocks and make money, you know, consistently based off earnings. Well, you know, there's been a lot of theories on that over the years, and I've spent a lot of money on those theories. But what we've been able to do is come up with, and I say we, I have a trading partner. His name's Jeff Smith. If you've been to Mobile, you know that Jeff and I have been together a long time. Also, Jeff and I have put together what we believe is a checklist that you can take earnings on different stocks. Everybody's got their favorites. Mine is Apple. I'll just be upfront about that. But every stock gives a sign on how to play those stocks. And so we've been working on it, and we got ready for this earnings season. We knocked it out of the park. I'll tell you a little bit more about that. But I want Jeff to go through some of the process that we do, and I asked him to spend about 10 minutes with you, not much more than that. It's sort of a favor he's going to do for me because he's real good at this portion of putting it together. But the first thing you want to do is take and figure out who is reporting earnings that you might be interested in. You know, there's a lot of earnings announcements, and then you got to figure out the strategy that comes back after that. But let's first look at a stock that Jeff's interested in, I was interested in, and then I'll come back on and tell you a little bit more. So Jeff, why don't you take it?
Thanks, Tom. Good afternoon, folks. My name is Jeffrey Smith. Known Tom for, I don't know, probably 25 years, been about, man, long time. Anyway, very quickly, there is risk in trading, so just beware that, you know, if you go click on the mouse and, you know, buying stock options or futures or whatever it is, you can lose money. There is always that risk, and know, they always say past performance is not indicative of future results, and sometimes that's a good thing. So, because you don't want to repeat the losers, right? However, everybody likes to win, but we do have to accept losses along the way. So now that we've got that all out of the way, I want to go through a little bit about earnings and how earnings kind of affect things. I think most people go through earnings season and they say, wow, man, that stock really went up, or wow, that stock really got dumped off. I want to talk a little about Wal-Mart, not to say it's a great earnings play, but its earnings are coming out Thursday. And it's a big bellwether kind of stock, if you will. So I thought we might kind of look at it just a little bit. First of all, I think most people realize that corporations report no profits/losses for the quarter or even for their fiscal year. The thing is, when we start looking at earnings, there's always a couple of different moves based off that earnings. I mean, how many times have you seen good earnings come out and you go, wow, that was really great, and you see the stock shoot up, and then you look at it 30 minutes later and it's making new lows on the day, and you're thinking, what the heck happened to that stock? I mean, why are they selling it off for such great earnings? And based off what's expected is one move, but once they read the actual report, you might get a totally different move. And that's the thing that we have to kind of prepare ourselves for, is just because they beat expectations and their revenue numbers are great, they might have all made it out of one specific product, but their other products aren't doing so well, so in the long run then it might end up hurting them. So that's the one thing that we have to kind of contend with when we start looking at earnings. And when we start looking at current earnings or coming up earnings, since we just kind of came out of earnings season, if you will, how were their earnings last time? A lot of them ended their fiscal quarter this past earnings season. Some of them don't end until July or whenever it is. But if you kind of look at earnings come out really through just almost every day of the year. The thing is, the bigger companies come in, the quarter or the month after the end of the quarter for about 4 to 6 weeks there, and then of course we get to wait and see what happens from there. But we do have to kind of look at what that expectation is and how the market begins to move off of it. When we start looking at trying to make money off of earnings, many earnings come out prior to the bell. A lot of them come in after the bell. So if you're out there trading stock, there are a lot of stocks that you can trade pre-market and post-market. You look at the NASDAQ stocks, you can go 7 a.m., 7 p.m. Central Time, or 8 a.m., 8 p.m. Eastern. But if you think about it, stocks do have a little more risk. The stock can move around a whole lot based off the earnings. You look at like Netflix, last, October, Netflix dumped off almost $100 a share, even though they had great earnings. The next day they just tanked off. You can trade equity options, reduce your risk, because if you just buy an option, that's the maximum you can lose, right? Of course, you can, if you get paid, there it is. We can trade the index futures. Index futures are a great way, pre-market, post-market, to take advantage of earnings announcements, especially in the NASDAQ stocks, because the NASDAQ stocks have a tendency to move around a whole lot more. So we can get a lot more volatility out of the NASDAQ, or the mini NASDAQ, traded at the CME, so we can look at those. Of course, we can also do options on futures. If you're more on the future side as opposed to the equity side, you might want to just trade the options on those, just because your maximum risk is what you've bought the option for. So there are various ways that we can take advantage of these moves. The thing is when we start looking at which stock we like, as Tom was mentioning just a few minutes ago, which stocks we don't like. Now we have to kind of start differentiating on what we know about a company and what we don't know. One thing that I would definitely do is learn how options work. They're a great way to reduce risk, but not only that. You can increase your gains and decrease losses by using options. It's just as simple as, if you buy a stock, you can sell a covered call against it, right? And that covered call brings in money, and therefore, if you go down and get stopped out on your stock, well, you don't lose as much because you brought in money off the covered call, so to speak. But we can use options as a great tool for trading. I'm not a real big quote-unquote trader of options. I think options are a great tool to use to take advantage of different things, or even to protect yourself, or maximize gains and minimize losses. So when we look at trading futures, we can use the futures markets to trade big earnings newses. Tom was mentioning Apple, but you have the Googles and the Netflix and the Amazons. Even Tesla can move around a whole lot. You have Priceline. I don't know. I've been watching Panera Bread and O'Reilly Auto Parts here lately. I've been trading them a little bit. Never thought I'd trade a bread company, but it seems to move pretty well, so I thought, what the heck. But when we start looking at stocks, there are going to be stocks that we know, and if you're familiar with the stock, you have a pretty good idea what you think the earnings are going to be. And we don't know what they're going to be, of course, but we have a pretty good idea that based off past performance, which again is not indicative of future results, but if you're coming out of Christmas and you've seen a ton of iPhone 6 sales and all this good stuff, odds are the earnings are going to be pretty good. If you did notice the sales have been pretty bad, odds are they won't have very good earnings. Some stocks are kind of hard to predict that way, and that's why we sometimes have to wait till after the news comes out before we start entering into the trade. There are some times we will enter into that stock prior to the earnings just because we have a pretty good idea, but we also have a strategy in case we're wrong. And that's the big thing. We always have to prepare for the bad side, just like everybody wants to make money, but we do have to prepare to lose money and how to minimize that loss. The biggest problem is trading a stock that you don't know. If somebody just says, hey, watch this off of earnings, it ought to move a whole lot, well, you might not know that stock. So how are you going to prepare yourself to trade that stock? Maybe you don't. Maybe you wait till the next quarter after you watch it this quarter and kind of watch it for the next couple, 3 months. That might be the most conservative way of doing it. But we can also start looking at, well, last time it had earnings, it did this. This is what they're expecting this time. So we can now start trying to familiarize ourselves with this and maybe even make a little money off of how it moves just by putting on different option strategies, or even looking at how the futures decide to move off of that. And that's the one thing that we're always looking for is how the market reacts to different earnings announcements. And of course, the bigger companies are going to affect the market a whole lot more than small companies. If you're familiar with a grocery store chain called Safeway, if its earnings come out, it's not going to affect the market any. And if you've never heard of it, that's probably why. If you're from on the other side of the west of the Mississippi or something like that, you might have heard of it. But it's not a real big grocery store chain, but there it is. But it's in the S&P, I believe it's 400 or the 100, whichever it may be. So it is a big enough company, but a company like that's not going to affect things very much. Williams-Sonoma, there's an S&P 500 stock. Its earnings come out. It doesn't affect the S&P a whole lot. However, you look at something like IBM. You look at even Intel, Microsoft, GE, 3M, JP Morgan. Those will affect those markets a whole lot more. So we do want to see how all of those stocks begin to affect these things. We can watch the indexes as they move around. But when we start looking at trading pre-market, post-market, the futures markets may be a little easier to trade at times, but we can look to get into the equity options prior to earnings announcements, but we're going to have a different strategy to do that, and that's really what we're going to try to teach you to do. So as I was mentioning before, I wanted to kind of run through a case in point in Wal-Mart. Wal-Mart, of course, this nation's, if not the world's largest retailer, or employer anyway, but they are the world's largest retailer last I saw. Their earnings come out Thursday morning at 7 a.m. Eastern Time, 6 a.m. Central Time. I think they're expecting like $1.54 a share or something like that. This is their fiscal, into their fiscal year, so it ended on the 31st of last month. So it has a 52-week high up at 90.97, has a 52-week low at 72.61. It opened this year on January 2nd at 86.07, and it opened this month at 84.90. And Friday or Thursday, whenever it was trading literally right in the middle of that 52-week high, 52-week low range. It was right around the 83, 82 area. So it was pretty much right in the middle. Today it had a little up day just because the markets were up. I think it's around 85 or so. So right now, with the markets moving higher, of course, Walmart's going to be moving up. One rule that we have, or the primary rule in trading, is that 75%, 75% of all stocks move with the S&P 500. So if you're seeing the S&P moving higher, even the Dow and the NASDAQ moving higher, odds are, the big bellwether guys are probably going to be moving up anyway. They might be weaker than the others. We might see one being dragged up. Really didn't want to go up. It's going to get pulled up just because the overall markets are moving higher. But for the most part, we'll see that. And that's really what you're seeing coming into Walmart's earnings this week is, well, the S&P just made a new all-time high today. So odds are it'll continue to move. And here's a chart just to kind of give you that little thought there. This is Walmart on the left side. You have the S&P on the right side. You can kind of see their patterns are kind of the same, but not exact. Notice we've been rallying up here in the S&P, and the gentleman who was on just right after 4 Eastern was showing the S&P and its trend and how strong it was, and it's broken out to all brand new high and things of this sort. So this chart was taken just a couple of days ago. Sorry about that. But you'll notice Walmart is not back up to its highs up here at 90.97. It's down here right around this 85.86 area, and it kind of started the rally here with the S&P coming off these little lows that we had, but all of a sudden we're starting to get into, this is a daily chart, getting into, well, here come the earnings, so people are getting a little more cautious, and that's a lot of times what you'll see is, if they think it's going to be a strong earnings report, you might see this continue to push higher. If they think it's going to be a weak earnings report, you'll see them down here trading toward these lows still and haven't moved up at all what the S&P has done. But right now they're kind of hanging out in their midpoint zone, if you will, between this high and this low. So as the S&P is up here toward the high. So we sit here and try to think, well, are their earnings going to be good? What are they going to do? Are their earnings going to be bad? What are they going to do? And how are we going to figure that out? Well, one thing you can do, I'm going to go to my next little slide here. This is an option chain on Walmart. These are the calls on the left side. If you're not familiar with an option chain, you got calls on the left side. Calls give you the right to buy, but not the obligation. And the put side, puts give you the right to sell, but not the obligation if you're a buyer of options. Down the middle here, we have strike prices. We have the Feb 20, 2015, which is this Friday. We have the Feb 27, 15, which is next Friday. Notice something here. This is what they call open interest, OI. And notice we have 3,000, 3,000, 5,000. Look at this 8750. You got 27,000 open interest on there. Basically, what this is trying to tell you is they're thinking that it's going to get there by earnings. Well, earnings are Thursday. This expires on Friday. So there's a lot of interest, if you will, in that 8750 area. If you're looking at the money options, we're right around 85.20 or so. Let's just say 85.50. They're right now, the at the money options are right around $1, $1.20, $1.20 here. You look at next week's, they're right around $1.45, $1.16. So they're probably looking for somewhere around a $2 move in this stock anyway, which from 85.5 up to somewhere around 87.50 is about $2. So it would look to me like people are expecting this to be a little more positive as opposed to negative. So a stock that I don't watch very much, I can already get a pretty good feel that they think this thing's going to be positive or not. Now, I'm not going to trade Walmart earnings just because, well, the stock doesn't move around all that much. I like something with a little more volatility in it. But it'd be interesting to see what they do with it coming into Thursday. Another one you can look at, most people are familiar with, is good old John Deere or Deere and Company. The symbol is DE, Delta Echo. It comes out Friday morning before the bell. I think they're expecting somewhere around like 85 cents a share or something along those lines. John Deere has been kind of beat up over the past 4 or 5 months just because the price of commodities, corn, wheat, soybeans, have been dragged down a lot, and if the farmers don't have a whole lot of money, well, they're not going to be buying a whole lot of equipment, right? So they've been really pulled down a lot. Usually you'll see Caterpillar and John Deere have a tendency to move together a lot. You've had Caterpillar, when their earnings came out last time, really kind of shot up, went up to over $100. John Deere didn't move a bit. In fact, the John Deere went from about 90, 92 bucks all the way down to 80. Right now, it's kind of bounced back up to about 85. So it'll be interesting to see what happens with John Deere. Again, another one of those big companies. We're very late in the earnings season, so we're going to be getting, I'm not going to say small companies, but the less volatile ones coming out. Usually the retail guys and the oil energy people are the last ones to report before we kind of officially end earnings season. But we can kind of watch how each of these little sectors begin to kind of move around and see if we can't make a little money off of them. So with that, I'm going to step to the side, turn things back over to Tom Busby, and he'll go from there.
Well, thanks, Jeff. And one of the things that you know, it's fun to look at this stuff. But Wal-Mart, okay, Wal-Mart's one that I would say doesn't meet the test that we've developed to tell us it's a play. And what I like to do on earnings announcements is playing on the day they make their announcement. And so that's one of the things that I like to do, because I think that's where you get the biggest bang for your buck. And you know, you cut your exposure down, and at the same time, when you're trying to, you know, ascertain what will be your play, whether it's going to be up or down, then you've got to take into account a lot of different factors. Now, these factors that you have to take into account are where you're going to find what's written out there that allows you to make money. Now, one of the things that a lot of people will focus on is what is the anticipated market movement of that particular stock. And so what we've done is taken the market movement and take a formula that takes the anticipated market movement and build a strategy that will pay us on that. And our strategy constructs in a way that worst case we get singles, best case we get a home run. So let me tell you what we've done so far this earnings season, and look at some things, because the earnings are the engine behind the stock. And I'm very excited about this because for years, you know, we thought we've had things, but they didn't stand the test of being able to give you that predictability that you need if you're taking speculative plays, and that's what we're talking about here. So far this year, I've traded each of these stocks: Apple, Netflix, Amazon, and Disney. And these stocks I've traded in publicly in front of our group of people to show people how this works. And it makes it pretty nice when you get these kind of movements. But if you think Apple, okay, Apple, okay, was trading about 111 on the day that they announced earnings, okay, and now Apple's up to what, 128. As an example, we played Apple long, and you can see the value of having that anticipated movement formula, because it put us long this stock, and we're still long this stock. In fact, I bought some more Apple today. Netflix, this was a big one. We looked at Netflix. You've been following Netflix. It had a slight grind higher, but Netflix, if you remember, had a big down move last year, and then finally it started getting grips, and then on this earnings play, they blew the doors off, and it's still up and going higher. Netflix, and this was another one that we played long on the day the earnings had announced. Amazon, this was one that last year sold off in December and stayed down for the majority of the year. It had a couple runs up to about 340 during October, I think October 15th up to 340 to November. And here's another one that our formula said play long, and we played long. And this formula that we developed is a simple step-by-step play that allows you, the trader, to position yourself once the filters. Either you got a long, or you have a short, or you have a stay out. Wal-Mart's a stay out this year, to give you some idea. Now, Disney. Now this was a interesting one. I actually bought Disney about 94, and it went down, and I lost money on Disney. This is an actual outright purchase on Disney. But on earnings day, which was a Wednesday, I went through our checklist, and it said get long. I bought an option on Disney for $1.35. $1.35, it's 135 bucks. Well, Disney blew out and blew up, and now it's at 102, headed to 110, and that option I had went from $1.35 overnight to around $5 or $6 the next morning. Now this was a good play. Another stock I don't show you, I did play publicly, was Green Mountain Coffee Roasters. I played it negative, and it went down. And Tesla is another stock that I played negative this earnings season. Now, what we're going to do at the end of the month, which is next Friday, we're going to put together a 2-hour class that we go through our checklist and then get you prepared to allow you to take the stocks you're interested in and see if there's an earnings play on the day of. And we're super excited about this because it's going to be in 2 hours where we go through this and cover the details of this checklist and the formulas that we use to allow you to give that predictability. And you can tell I'm pretty excited about this earnings season. I'm even more excited about next earnings season, okay, and the plays that we're going to make, coming into next. I can tell you right now, Apple will definitely be one of the plays. I played it learning this, and I will definitely have it included in my 10 plays. But that's the date, the 27th. It's going to be at 10 o'clock to 12 o'clock on that day. And what's so unique about this is that we'll be able to go through that, and we're also going to show you in conjunction, Jeff mentioned futures, how to use the indexes on the day of after the earnings and show you how that works with the earnings play. So the class is pretty compact, but it's got essential information. It's sort of the executive summary of how to do this. Now, when you leave this class, you'll have a strategy you can customize for your view and the stocks you want to play when earnings come around. Everybody's got their favorites. I'm telling you, I've been in this business for a long time, and everybody's got their favorites. I know I've got mine. You'll have yours. But this formula is universal. It will work for each of these stocks. So we'll cover the market maker move, how to figure it, how to use it, and then the formula that we say is go or no go. We'll give you the likely movement that the stock projects to and show you how we got that. And then we'll show you how to construct a strategy that will give you a home run, okay? We also, in this strategy, will show you what happens if we don't hit a home run and the single that's there also. The websites that we use, there's a list of them that we use. We think they're better than that. And then we'll give you the strategy and the legs that you will use each earnings play depending on your bias, up or down. And that's the neat thing about this. It's simple, it's straightforward, and everybody here can learn this through this setting. We're going to record the setting where you can play it back over and over again until you memorize these steps, and then you will have that as your background to make your plays. Now, earnings, like I said, I've been playing this for years, and finally we have something that's really exciting, and the recording will be available to you on February the 27th from 10 to 12. So that's when it's going to be. Oh, the cost of it, okay. It's 27th, and after you go through the class, you can watch me do Apple Live, the next Apple earnings class. We'll invite you to that as part of your subscription on this. It'll be on April 23rd when we do it. And there it is right there. There's the link. You can call if you got any questions. But I think this is something that even if you really don't specialize on trading earnings, you'll want to know this information. It's just to help you with your day-to-day movement of stocks that you follow. So I want to thank Fausto for inviting us here. Get prepared for that next quarter and I'll see you there on the 27th. Let me see if there's any questions anybody has. Anybody got any questions for me? There's the link. Well, perfect. Now, Adam, they will also be able to get we'll give them 4 or 5 days in our trade room where they can watch us warming up for this class, right, next week. So Monday through Friday, they'll be able to set in our actual 24-hour trade room. Okay, good. You'll get that as part of your bonus. Well, thank you, and see y'all next week.